Hey everyone, this is Hunter Satterfield, the Chief Investment Officer, as well as one of the partners here at Kane Waters. As always, I am joined today by one of my fellow partners, Brian Bortz, who is also the head of the CWA Investment Committee, and then also Brad Sanders from Tectonic Advisors. Thanks again for joining me, guys. This is your April monthly market update. For the month of April, the S&P 500 was down 8.7%. Global stocks down 7.9%, domestic bonds down 3.8%, and global bonds down 5.5%. So to reiterate again, that's just for the month. It was a very, very ugly month overall. And Brad, as always, I want to come straight over to you. Obviously, those numbers are not just bad for the month, but on top of the first 3 months, the first quarter of the year, which has been really, really tough and volatile as well. So talk a little bit about what happened acutely in April to kind of create that volatility for the month, please.
Yeah, I think, anytime we're talking about this market, we have to start with the Fed. The Fed is basically talking the bond market higher. They're talking rates higher. They've only done one rate hike of 25 basis points, what they did in March. They've already said they're going to raise 50 basis points tomorrow. Those are all priced in, but the market's priced in 10 rate hikes at this point. So the Fed's using kind of their words to influence the markets to get the yield curve steep, and in order to kind of get the markets to start doing what they want to do to help tame inflation without having to actually enact policy. And I think they're doing that because they know that, they may not be able to raise as much as already is priced into the market, particularly with what we've seen going on already. Anytime they say the word interest rates, the market drops and yields go up. We had a negative GDP print, negative 1.4% that came out Friday, which that really, kind of put the cherry on top of the horrible Sunday for the month of April, was what caused that. But they're all interrelated, really. We're starting to see rates move higher. We have high inflation. The economy's, starting to stutter a little bit because of that. And it's starting to show up in the markets, particularly in April. We saw some real carnage in the NASDAQ and technology stocks. We've been talking about kind of these mega cap tech stocks that were priced to perfection for years now. And, whenever you get companies like that and stocks like that, it's all fun and games until it doesn't go right. And generally when it doesn't go right, it's pretty brutal. And we saw that with a bunch of rounds of earnings. That's just been a mess. And, those companies, while, you're talking one company, companies like Apple make up a pretty big chunk of the S&P 500. So you kind of have everything just kind of coming together at once. The negativity is probably the highest it's been in the last 5 or 6 years. That's generally a pretty good contrarian bullish sign that probably we're due for a bounce and things are oversold when things are this negative. But that's really what's reflected in the market is the amount of negative sentiment, the potential for higher rates, the potential for a slowing economy, and the potential for maybe more and more earnings to come in, maybe like some of these big tech companies had, and that would spell trouble for stocks that are trading at higher multiples.
Yes, great, thanks. And I think that I've had a conversation with several clients, and oftentimes I think that clients really are kind of longing for that one thing, right, that was maybe creating the instability in the market or the volatility in the market. And we saw that obviously with our last big significant drawdown in March and April of 2020. It was one big thing, kind of an unknown event, obviously, for all of our investors. And, this one, Brad, to kind of talk about what you have, I mean, there's just a lot of stuff that's going on and all those different things, whether it's GDP or inflation or Fed rate hikes or whatever else it is, that is creating this sort of unknown. And I think that's what a lot of what's happening and why we see sort of these big, drawdown numbers. And so, Brian, kind of coming over to you, I mean, we see markets down, 12, depending on what index you're looking at, 12 to 20% this year. Again, that's not just this month, but on top of what we already had. Again, kind of what's the messaging that you're discussing with clients? What's the bottom line that you're trying to get them to understand the why of what they should do at this point with their plans?
Yeah, thanks, Hunter. I appreciate it. Actually, I've had an increased number of conversations with our clients about volatility and just reminding them that whenever we put together our investment advice and our portfolio advice, we start with what their risk tolerance is and have a really good understanding for events like this. It's just we haven't had to go through a recession other than a brief COVID correction since '08, and that's a really long time ago, relatively speaking. And so just reminding them that we've already planned for this in advance before it ever happened, and that there's really no reason to make permanent changes to their portfolio if this is a temporary economic event. So it's talking to them and letting them understand that we are aware that this was going to happen, that we've planned for it, and that the volatility in their portfolio is appropriate.
That's great. Thank you for that as well. And I think that obviously we're only 4 months in to all you as viewers. So we thank you for joining us again. And we'll be back in front of you at the end of May. Lots to come and lots of things that are going to happen, as Brad had mentioned, here in the upcoming month. So please look out for us on our next video at the end of May. Thank you so much.